In my last video titled GameStop Endgame, I made the comment that Reddit-inspired traders who were trying to engineer a short squeeze on GameStop stock were doing it all wrong. I said that what they really should be doing if they wanted to crush the short sellers was to take delivery of their shares. I've had some questions from people asking about taking delivery of shares, so I'll discuss it in this video. First, I'll give the very basics of share settlement and explain the problems as I see it. Then I'll discuss ways to prevent your shares from being lent. Please do not take this as me trying to lead a movement to break the system. That's not my intent here. But if in the process of investors taking action to protect themselves from share lending, it leads to the failure of some large trading houses that engage in heavy short selling, then so be it. Here is a fairly complicated picture showing the DTCC, which is the Depository Trust and Clearing Corporation. It was formed decades ago by the merger of the DTC, which is the Depository Trust Company, and the NSCC, which is the National Securities Clearing Corporation. The DTCC is a very large securities clearing corporation which is owned by its users. It helps all of the participants clear securities transactions. The DTC is a depository that maintains custody of active securities. When I looked at it, they had custody of securities of over 1.3 million types, spanning more than 131 countries. The NSCC is the organization that actually does the clearing work of settlement trades between the various members. You can see here only a selection of the members. There are many more than you see here, but I picked out the most recognizable names and placed them on the slide. The DTCC is almost like a central bank for securities transactions. It holds the securities, and it also holds a certain amount of cash from the members to ensure that when trades are made between the various members, they can be honored. Let me show you in the simplest terms how the system works when trades are executed. But first though, let me ask you to please hit the like button on this video for the sake of making the video available and visible to others. The actual functioning of the system is much more complicated than what you see here, but I'm going to leave out many details so that everyone can have just a very high-level understanding of what's going on under the hood. In the marketplace, when securities are traded, there are bids from people who want to buy securities for cash and offers from people who want to sell securities for cash. The market and its agents are there to serve the purpose of matching the buyers with the sellers. When the bids and offers are matched, the transactions can take place, and this is what generates a current market price for a security. Let's suppose that we have one party who works with broker 1 and wants to buy 10 shares of GameStop. He will issue a buy order. Broker 1 then matches his order against what the broker sees offered in the system. The broker will send back a confirmation that the trade was successful. Similarly, let's suppose that there are a couple of distinct clients working with broker 2 and with broker 3 who each want to sell 5 shares of GameStop. Their brokers will match orders and provide confirmation to their clients that the trades were successful. During this entire process, the brokers are communicating with the NSCC. They send trade information to the NSCC, and the NSCC responds back with a report of how much cash is to be exchanged and what the securities totals will need to be. So why do we need this service? And the answer is that the trades don't settle instantaneously. Settlement occurs 2 days after the trade, and this is when the securities and cash change hands. Understand, though, that the vast majority of securities are registered in street name. This means that the brokers don't hold them. They have book entries that say that they own them. The actual physical securities, or in some cases electronic securities, are held at the DTC. So the question that should naturally arise is, what happens if one of the parties defaults in this 2-day period? Think about it. The DTCC provides settlement of about 1.4 million pooled transactions each day, and these transactions involve multiple parties. If one of them defaults, then how is the system to determine who owns what at the end of it all? This is what happened when 2 Bear Stearns hedge funds defaulted and nearly took down the entire financial system in the late 2000s. So what's the big deal? What I've shown here looks pretty simple. How can such a system fail? Enter margin. The parties shown here can buy securities using cash that is not their own and also sell securities that are not actually their own. and the brokers are more than happy to let them, because it generates big commissions and interest for them, as I will show on the next slide. Ever wonder how brokers can offer commission-free trades and still make a profit? There are speculators out there who will borrow cash to buy securities in the hopes that the price of the securities will rise and they can close out their position at a profit. There are also speculators who are there who will borrow shares so that they can sell them on the market in the hopes that the price of the security will decline and that they can close out their position at a profit. If a broker lends out a lot of shares that technically belong to their clients, and then their clients decide that they would like to sell those shares, it creates a bit of a logistical problem. The shares need to be returned, at least in book entry form, before they can be sold, and if their clients want to sell them in the meantime, that creates a big problem. The other problem has to do with cash. If too much cash has been lent for buying securities to cover trades over a short period of time, then the clearinghouse may require more cash to be posted by their members. And this is actually what happened to Robinhood a couple of weeks ago, by the way. So you get the picture. During any 2-day trading period, there will be many transactions that need to clear and quite a bit of counterparty risk. A default can generate big problems. Let's talk a little bit about securities lending and how you can prevent your shares from being lent. As I said, the short sellers need to borrow shares in order to sell them, and they are willing to pay for this loan of securities. Securities lending is a big business. It's done by brokers, by mutual funds, and by exchange-traded funds. Even Vanguard started doing it a few years ago. When this lending is done, there is an agreement between the short seller and the lender to return the securities by a specific date. Whoever lends the securities receives interest. Ever wonder how management fees for funds can be as low as they are? Ever wonder how brokers such as Fidelity and Robinhood can offer commission-free trades and still make a profit? Well, now you know. Do the actual owners of the securities benefit? Sure. In the case of mutual fund and ETF owners, they can enjoy lower fees and perhaps higher dividends than they otherwise might. Clients of brokerages can also enjoy commission-free trades and fee-free account maintenance, but it does come with a hidden cost. The cost is the risk that if you want to sell your stock and it has been lent out. And this is generally a very small risk. The reason for this is that the broker will usually have many more shares in their inventory than they have lent out. If yours were the ones that they lent out, they can replace the shares with others that are in their inventory. Sounds a bit like fractional reserve banking, doesn't it? Well, that's exactly what it is. Now, the other risk is the failure of the counterparty, though the DTCC is there to ensure that the counterparties are sound enough to honor their trade commitments. But then again, the DTCC was also around years ago when Bear Stearns' hedge funds failed. But let's suppose that you are not comfortable taking this small amount of risk. Or suppose that you are an activist shareholder or a group of activist shareholders who don't want short sellers to be able to drive down the price of the penny stocks that you bought. What can you do? Well, if you're a mutual fund investor, one thing that you can do is select only non-lending funds. They're out there, believe me, I know. I hold a substantial position in a non-lending fund myself. If you are a stock investor, you can simply take this stock out of street name. The reason to do this is because brokers can lend anything that is registered in their name on their books. Now here's how to do it. First, you need to identify who the transfer agent is for the particular stock you own. You can find this in the company's annual report. All companies will have a transfer agent. Then you call the transfer agent and confirm that paper certificates are an option. Yes, I have done this before, by the way. The next step is to call your brokerage firm and ask them to transfer ownership of your stock to direct registration. They may try to talk you out of it, but having ownership transferred to you is a right. If the broker keeps you from doing this, you might consider transferring your account to another brokerage. Once you have the securities registered directly to you, the next step is to call the transfer agent and request paper stock certificates be delivered to you. The transfer agent will have access to them only after the shares have been directly registered to you. Now, this step of requesting the paper certificates is going to require some paperwork. Fair warning though, this will cost you some money. When I did it, I think I remember the whole process costing me about $50, but this was more than a decade ago. You will be delivered your share certificates within a few weeks. Then it's just a matter of maintaining them in a safe place. You'll probably want to photocopy them just in case. If you lose them, you can have them replaced by the transfer agent, again, for a cost. Once this process is done, the shares will no longer be lendable, and any dividends paid will go straight to you at your registered address. Can you imagine if the Reddit crew had decided to take this extra step with the GameStop stock? I bet the price wouldn't have crashed back down if they had. So anyway, there you have it. It's a basic overview of how the system works, the risks associated with securities lending to the short sellers, and what you can do if you are uncomfortable with taking this risk. I look forward to our conversations about this in the comments section. If any of you decide to do this with your own shares, please share your experience so that others can learn from them. Thanks for watching.